Your account is up 20%. But that number alone does not tell you where the gain actually came from. The return may have come from a business generating more real profit and cash flow. It may have come from a company using a high share price to raise capital, redistributing value between existing and new shareholders. Or it may simply have come from another investor who was willing to buy your shares at a higher price. All three gains appear in the same brokerage account. Economically, they are very different. Business operations can create new wealth. Equity financing changes the cash a company owns, and it can also change the amount of business value represented by each share. When the business itself has not changed accordingly, and investors are only exchanging the same ownership claim at different prices, wealth is mainly being transferred among market participants. Understanding these three sources tells us where to focus our research: on the business, the financing, or the behavior of other market participants. A share of stock represents ownership in a business. A business combines capital, labor, technology, and organizational capability to provide products and services to customers and earn a profit. Tesla combines batteries, software, manufacturing equipment, and employees to produce vehicles and energy storage products. Microsoft combines engineers, software knowledge, and data centers to provide operating systems, productivity software, and cloud computing services to businesses and individuals. Walmart uses large-scale purchasing, distribution centers, store networks, and inventory systems to move a huge range of products to consumers more efficiently. These companies sell very different products and operate very different business models. The underlying economic process is the same. They solve problems for customers and retain part of the value they create as profit. A company can distribute that profit to shareholders or reinvest it in research, equipment, stores, supply chains, and new products. As long as those investments generate additional profit, the company's revenue, cash flow, and intrinsic value can continue to grow. These operating activities create real products and services while generating additional profits and cash flows. They expand the total amount of wealth in the economy. That is why the most important foundation of long-term stock returns is the new value created by business operations. Market prices can fluctuate sharply in the short run. Over the long run, prices still need support from profits and cash flows. A public company has another important ability. It can issue shares to investors. It can also use its shares to acquire another company or list a subsidiary and sell part of that business to the public. A stock market valuation, therefore, has practical value. When the market is willing to pay a very high price for a company's shares, the company can give up a relatively small ownership interest in exchange for a large amount of cash or other assets. In 2020, Tesla's share price rose dramatically. Through at-the-market equity offerings, the company raised nearly $5 billion in net proceeds. This demonstrated one practical advantage of a high market valuation. Tesla converted the price investors were willing to pay into nearly $5 billion of usable capital. The company could use that cash to build factories, expand production, develop new products, repay debt, or strengthen its balance sheet. But completing an offering at a high market price does not automatically prove that existing shareholders benefited. We still need to compare the issue price with the company's intrinsic value at the time, and then examine how management used the capital. A high share price creates a financing opportunity. Whether that opportunity increases value per share requires a separate judgment. When investors evaluate a share issue, many begin by comparing the issue price with book value per share. That comparison is not enough. The real question is simple. Did the company receive more value than it gave away? Let's put the numbers side by side. Suppose a company has book value of $40 per share and intrinsic value of roughly $100 per share. It now issues new shares at $60. From an accounting perspective, $60 is higher than $40. Book value per share may increase after the offering, which can look like good news. But economically, the new shareholder is paying only $60 for an ownership interest worth roughly $100. Existing shareholders have surrendered part of the company, and the cash received is not enough to compensate for the value given away. The accounting number has improved, while intrinsic value per share has been diluted. If the company can instead issue shares at a price clearly above $100, the cash paid by new shareholders may exceed the value of the ownership interest they receive. In that case, intrinsic value per share for existing shareholders may increase. Here, we are looking at the value transfer that occurs at the moment of financing. The long-term result also depends on how the capital is used. A company may issue shares at a very favorable price and then destroy the benefit by investing the cash in low-return projects. A company may issue shares at an unfavorable price and later offset part of the initial damage by investing the money at exceptionally high returns. A complete analysis, therefore, needs to examine at least three things: how the issue price compares with intrinsic value, how much ownership the company gives away, and how management intends to use the capital it receives. Book value tells us how the accounting numbers change. Intrinsic value tells us what existing shareholders actually receive in economic terms. Equity financing can also cause permanent damage. When Berkshire Hathaway acquired Ginkgo Re, a reinsurance company, Berkshire paid mainly with its own shares. Years later, Warren Buffett acknowledged in a shareholder letter that issuing 272,200 Berkshire shares to complete the acquisition was a serious mistake. The transaction increased the number of Berkshire shares outstanding by 21.8%. Buffett later concluded that Berkshire shareholders had given up far more value than they received. This example shows that using shares to acquire another company is also a form of financing. Management gives the seller part of its own company in exchange for another asset. When management issues shares at a price below their intrinsic value, existing shareholders permanently surrender part of their future profits and cash flows. Even if the acquired business later performs reasonably well, it may not make up for the excessive price paid at the beginning. So when a company announces a share offering, a stock-funded acquisition, or another equity financing transaction, the important questions are these: how much value per share did the company give away? How much cash or asset value did it receive? And after the transaction, did intrinsic value per share rise or fall? A large financing only tells us that the transaction was large. An increase in value per share is what tells us that shareholders benefited. A parent company can also separate part of its business and list the subsidiary independently. This is economically similar to selling part of the subsidiary's ownership to public investors. If the market price is higher than the reasonable value of the interest being sold, the parent may give up only a small stake, receive substantial capital, and still retain most of the economic interest. If the offering price is too low, the parent is effectively selling a valuable asset too cheaply. And if the proceeds are invested in low-return projects, even a favorable issue price cannot guarantee a good long-term outcome. The standard remains the same. What did the company receive? What did it give away? And what ultimately happened to value per share? Business operations change profits and cash flows. Equity financing changes corporate cash, share count, and the distribution of value among shareholders. Market price movements are more complicated. Some price changes reflect new information about the business. When product demand, competition, interest rates, industry supply and demand, or perceived risk changes, investors revise their estimates of future cash flows and fair value. Other fluctuations occur when intrinsic value has not changed very much. Market sentiment, capital flows, and price trends then push investors to exchange the same ownership claim at different prices. This section is mainly about that second type of movement. Suppose the intrinsic value of a company has not changed materially. One investor buys at a lower price and later sells at a higher price. During that period, the business has not created enough additional value to explain the entire price difference. Most of that gain comes from the next investor being willing to pay more. If the price later falls, the later buyer may eventually bear the loss. The company did not produce an extra vehicle, sell another software subscription, or add a new distribution center because those trades took place. What changed was who owned the shares and how much each investor paid. When a price increase is not supported by a corresponding change in business value, one investor's gain ultimately depends on another investor paying or continuing to hold at that higher price. Across a complete cycle, those excess gains and losses are redistributed among market participants. Meanwhile, commissions, bid-ask spreads, taxes, data expenses, and other costs reduce the combined result. That makes short-term trading a competition that demands a genuine relative advantage. In this competition, an individual investor may be facing professional teams with real-time data. Mature quantitative models. lower transaction costs, and automated execution systems. Their strategies may have been developed over many years, tested on enormous datasets, and supported by infrastructure, talent, and capital that are difficult for an individual to match. Spending more time watching the market or feeling more confident in your judgment does not automatically close those structural gaps. There are, of course, individual traders who succeed over long periods, but anyone who plans to profit from short-term price movements needs clear answers to three questions. What exactly is my advantage? Why should that advantage persist? And is it strong enough to cover mistakes, competition, and trading costs? More time and more emotion do not constitute an advantage. A simplified model can help explain how market prices move. Some investors study the business and estimate its intrinsic value. Because they use different information and assumptions, one investor may believe a company is worth $40, another $50, and another $60. Other investors focus mainly on price trends. When the share price is far below the value range estimated by fundamental investors, they begin to buy and push the price upward. The rising price may then attract trend-following investors, moving it even farther from its starting point. As the price approaches or exceeds the estimated value range, demand from fundamental investors begins to weaken, and some investors start selling. When upward momentum fades, trend-following investors may also begin to sell and reinforce the decline. Once the price returns to a range where fundamental investors are willing to buy again, new demand appears, and the downward pressure may begin to ease. This model is highly simplified, but it helps explain two observations. First, a stock can fluctuate even when the company has released no new operating information. Second, when the company's future cash flows genuinely change, fundamental investors revise their estimates, and the long-term trading range can shift as well. Sentiment and trends can move prices in the short run. Business results determine what can support prices over the long run. Now return to the title of this video. How is wealth created and transferred in the stock market? When a company sells more products, improves efficiency, and expands production, it creates additional profit and cash flow. That part of the return comes from real growth in wealth. When a public company issues shares, uses stock to fund an acquisition, or lists a subsidiary, value is redistributed among the company, new shareholders, and existing shareholders. Whether the transaction helps depends on what the company receives, what it gives away, and what ultimately happens to value per share. When the value of the business has not changed accordingly, and investors are simply trading shares at different prices, wealth is mainly transferred among market participants. After costs, this is a competition that demands a real relative advantage. Once investors understand these three mechanisms, they can define their own position more clearly. If you plan to rely on businesses creating wealth, your attention should be directed toward business models, operating results, and value per share. If you expect corporate financing decisions to contribute meaningfully to your returns, you need to study issue prices, dilution, asset exchanges, and the use of proceeds. If you plan to profit from price fluctuations, you must explain why you can maintain an edge over your counterparties after trading costs. Each path has its own research focus, required capabilities, and risks. The greatest danger is failing to decide which path you are actually following. You may buy for business reasons, but allow every price movement to control you. Or you may trade on market sentiment and then redefine yourself as a long-term investor after the trade goes wrong. Once you understand how wealth is created and transferred, you can identify the game you are actually playing. That choice determines what you must study, how long you must be prepared to wait, and how you should respond to market volatility. That is the starting point for building a coherent investment system.